Okay, so for this last chapter, we will talk about just some of the terminology. And one of the first ones I want to talk about is residual income. And residual is kind of like what's left over, an income, profit. And so if you have, for example, a sales of $300,000, or let's say $3 million, and let's say we have an operating income of $600,000, and you want to say, is that good? Well, we've got to compare it to something to know if it's good or not. And so let's say that our average operating assets are $2.8 million. And so that's what we use to make this money, so to speak. And we have a minimum required rate of return of 18%. So what we want to know is on this investment, what was our return? Our minimum return is $504,000, but we got $600,000. So our residual income is what we have left over after the return. That's all it is. It's just that straightforward. Another thing we look at is return on investment. And so in this same problem, let's look at what we call margin, which is our net operating income divided by our sales. And so our margin in this one is 20%. Now, what does that mean? Well, it doesn't mean a lot unless we have something to compare it to. So we look at the industry, we look at benchmarks, we look at last year and the year before. Another thing we can look at is turnover. And our turnover is our sales over our average operating assets. So with this one in mind, we would have our sales divided by our average operating assets. So we have a turnover of 1.07. Again, what does it mean? Not a whole lot unless we have something to compare it to. And again, we have benchmarks and we have standards and we look at last year and so forth. And then the other thing we can look at is our ROI, or return on investment. And for ROI, we're looking at our operating income divided by our average operating assets. So our ROI would be our operating income divided by our assets, or 21.43%. We had a minimum required rate of return of 18, so our ROI is good. And so again, just some measures that we look at when we're trying to determine how we're doing, how we're performing. You can also do bonuses based on this and so forth. Some other things that we look at in manufacturing is throughput time, manufacturing cycle efficiency. We look at non-value added activities. We look at delivery cycle time. And all of this is based on lean production. So if we've got a scenario where we have inspection time, and it's 0.3 days, and we have wait time, and it is 14 days. Actually, let me do this different. 3. So in case I want to use them in formulas, I can. And we've got process time, 2.7 days, and we have move time, 1 day, and we have queue time, 5 days. So this is just some information we have, but again, like comparing it to others in the industry, comparing it to benchmarks, and comparing it to previous periods and projecting forward, we want to look at some of our measures that you would see on a balanced scorecard. So we would look at throughput time, for example, and you can find the definition of throughput time in the book. And I copied that definition so that I would have it. Throughput time is our process time plus our inspection time, plus our move time, plus our queue time. So it's 9 days. Another thing we might look at is our manufacturing cycle efficiency, or MCE. Again, you would see this on a balanced scorecard. And this is our value added over our throughput. Now we know what our throughput is. We calculate that. That's 9 days. What is our value added time, though? Well, if you look at the definition in the book, you'll see that for this particular scenario, value added is only processing time. So that one is our 2.7 divided by 9. So we have a manufacturing cycle efficiency of 30%, which, is it good, is it bad? I don't know. We have to compare it to something. And then it asks us what percentage of throughput time was spent on non-value added activities. And so we want to look at the definition. How do we define that? And again, kind of see why it's really important that we get this information correct. And the way this works is if 30% of throughput time was value added, then 70% is going to be non-value added. So that's how that is defined. We also can look at delivery cycle time. And delivery cycle time is our wait time plus our throughput time. So that would be our 14 days plus our throughput time, or 23 days. And then it asks us in this problem that I'm looking at, if by using lean production, all queue time is eliminated. So in other words, nothing's ever sitting there waiting to be queued up. What would be the new manufacturing cycle efficiency? So if we take queue time out, then our throughput time, so this is lean production, our throughput becomes 4 days, because it was 9, but we're going to get rid of queue time. So now we have 9 days, and our value added is 2.7, and if we have a new throughput of 4, then our new manufacturing cycle efficiency becomes 67.5%, which is significantly higher than what we had before. So that's how lean production can have an input on your balance scorecard. So that's it, your last video lecture. You've got your integrated problems also this week, but that's just a combination of what we've already done this semester. So you should be fine with that, and you should be ready to study for your final exam.